Hi everyone, thanks for tuning in. So in today's session, I'm basically just going to answer the question that you're seeing right on your screen. So we have a question here. It says, Taxation and Finance examination scores for students of Smart College were computed and summarized in the table you're seeing. So we are being required to determine Karl Pearson's coefficient of skewness for both scores. And also secondly, we are going to comment on the performance in terms of spread and skewness in the above two courses. So this looks pretty straightforward, so we'll get started. Alright, so what's the formula for Karl Pearson's coefficient of skewness for both cases? I'm going to quote the formula we're going to use here. The data we have is mean and median. We do not have mode, so we're going to pick the formula that has mean and median in it to determine Karl Pearson's coefficient of skewness. So this is going to go like this. We are going to write, so it's going to become 3. It's actually 3 into brackets mean minus median, like that, and we're going to divide that by the standard deviation. Like that. So we're going to go right ahead and start with the taxation. Okay, let me write it here. So taxation, let's get coefficient of skewness for taxation, the Karl Pearson's coefficient of skewness. So for taxation, it's going to be 3 into brackets. We're simply just going to, to substitute. So what's the mean? So when you come to taxation here, the mean for taxation is 85.17, so that's going to become 85.17 minus the median. Okay, right here we are following this formula. The median is 82.50. I'm going to close brackets right there, and so I'm going to divide all that by the standard deviation, which is 4.48. So once I get to that, the answer I'm getting here is 1.788. So that's the coefficient of skewness. We get Karl Pearson's coefficient of skewness we get for the taxation data. So I'm going to go right ahead and do the same for the finance data. So I'll come here and say, so for the finance data, still it's going to be 3 into brackets. Still, take note, I'm following this formula right here. So it's mean minus median. And so for the finance data, the mean is 85.5. So I'm going to come here and say this is going to be 85.5. Subtract minus the median, which is 89. So that's minus 89. Divide all that by 4.25. 4.25 so happens to be the standard deviation. So what do we end up with? We shall end up with a negative value here of negative 2.788. So when you look at those two, we have finished answering the first part of the question, which requires us to determine Karl Pearson's coefficient of skewness for both scores. Now, what do these figures actually mean? Because now it's when you go to Roman 2 here, it says that comment on the performance in terms of spread and skewness in the above two courses. So we're going to comment on this. We're going to comment on this figure. We're also going to comment on that figure. What does it mean? So before I explain what these things actually mean, maybe for those of you that, just to take you down memory lane regarding the theory behind this whole skewness business, let's do it this way. First of all, when we are talking about a normal distribution, okay, a normal distribution looks something like this. That's a normal distribution of data, okay? And in a normal distribution, we know that our mean is right there at the center. We know that our median is also right there at the center, and also our mode when I'm talking about the mode, we're talking about the item that has the highest frequency. Okay, they all coincide in the center right there. Okay, now this is a normal distribution. Now if a distribution is skewed, by skewness we mean to say by what degree is it deviating from this normal distribution. That is what it means. By what degree is it deviating from this? Now that is, if I'm to state it in, I'm simply trying to state it in layman's terms. That is what we mean by skewness. By what degree is it skewed from this normal distribution? And so for that to happen, for it to be skewed or for it to go away from that normal, it is either it's going to look like this. Either, first of all, remember at first the mean, mode, and median are on the same plane here. Okay, now if it is skewed, it's mostly because there is some distortion of data. Now of course the mean will always remain in the same place. Okay, because by definition we know that the mean, I'm talking about the median. Okay, by definition the median will always remain in the same place. Okay, let me draw some two extra graphs here to illustrate this further. The median will always remain in the same place. What does it mean? Because by definition we know that a median is that it's that part of the data in the middle, like the way as you hear the word median. So the median will always be in the middle. Okay, but then now sometimes the mode, remember by definition mode is the number that has the highest frequency in a data set, or the item that appears the most. That is the mode. That is why when it is normally distributed, the mode is it's where the peak is. But sometimes the mode can be on either on the right side of the peak or on the left side. You might find that the mode is, let's say the distribution is like this. Okay, like that. It means that this is the median. Remember, it's the middle part. This is the median. Okay, so you find that the mode is there. The mode has shifted. This is the mode. Okay, so we have the median in the middle because it's supposed to be the item in the middle of the data set. The mode is the one that has the highest frequency. So sometimes you might find that the mode is on the left hand side of the median, of the middle part. Sometimes the distribution can look like this. Okay, you find, yes, this is the median. Okay, and then this is the mode. So you might find that this is actually the mode. So I'm giving you here scenario A and scenario B. In scenario A, you're going to find that the mode is on the right hand side of the median, and in scenario B, you're going to find that the mode is on the right hand side of the median. In these two scenarios, A and B, because they are deviating from the normal distribution, in other words, they are not perfectly synchronized with the way the normal distribution looks like, then we consider these distributions A and B to be skewed. Okay, so now when we are looking at for the coefficient of skewness, for example here, Karl Pearson's coefficient of skewness, where we have 1.788 and we have negative 2.788, those coefficient of skewness are actually trying to show the degree of the deviation from the normal distribution. That is what we mean by skewness. Okay, so now that being said, now because this data has been skewed, remember in the beginning here, its mean, that is remember the other word for mean is average. Okay, you'll find that its mean is at the center. Okay, in the normal distribution, the mean is at the center. The mean, the mode, the median are all in the middle. But now when the data is skewed, it means the mean is and the mode and the median are not going to be aligned like the way it is in the normal distribution. The mean will tend to be pulled in another direction. For example, let's look at section at A. When you look at A, you're going to find that the mean will be, because yes, we have most of the data on the right hand side here, okay, but because we have a long tail, okay, remember this is a tail, this is a tail, so because we have a long tail towards the right as a consequence of these other figures that are low, high figures but towards the right, low frequency, you're going to find that the mean is going to be pulled towards this way. So you find that in this case, the mean will normally be right there, okay? And the reverse is true here. Because we have a long tail coming towards the left, yes, we have a lot of values towards the right that are very high, but because we have a very long tail, in other words, we have a lot of, you know, a significant amount of values that are low, with a low frequency pulling us towards the left, you're going to find that the mean of distribution B will also be pulled towards the left, okay? This is the mean. So you'll find that if you look at this mathematically, you look at our equations here, okay? When you look at our equation here, it is 3 into brackets mean minus mod, okay? So when you look at this part of the equation, mean minus mod, right there, what you can only get a positive answer when the mean is greater than the median, okay? It's mean minus median actually. So when our value of mean here is greater than our value of median, you're going to get a positive value. When we come to our diagrams here, where is the mean greater than the median? You realize that in our point A, our mean here is in front, it's having a greater value, and our median is here behind. So meaning that if we get this value, okay, if we get this value of mean minus that value of mod, we are going to get a positive value. Because we have a positive value, it means that graph A is positively skewed. This is positively skewed. Okay, it's positively skewed. So what you should know is that positively skewed has a longer tail towards the right. And then the reverse is true in our diagram B. If you look at our diagram B here, you're going to realize that still, if you get back to our formula here, okay, our formula up here, when our value of mean is less than our median, in other words, a smaller figure, mean, minus a bigger figure, which is median, you're going to end up with a negative value. So because we end up with a negative value, you're going to find that here, yes, if you're to look at, if this was like your number line here, you realize that our value of mean is lower, okay, our value of median is higher. So if you get mean, which is a lower figure, minus median, which is a higher figure, we are going to end up getting a negative value. That is why this becomes negatively skewed. Okay? Okay, so now having understood that, now like that was just more like a theoretical reminder of the theory behind skewness. So having understood that, now we can ably answer this question using your own English now, because they're telling us that comment on the performance in terms of spread and skewness in the above two cases. So if you look at taxation, the data for taxation right here, this is the data for taxation here. When you look at our calculation here for taxation, we have a skewness of positive 1.77. So if we have a positive 1.77, it means that our data looked like this. It looked like the diagram in part A. It was like that. It was positively skewed. Okay, that is how our data looks like. So it means that the mean was greater than the median, that is 1, and it had a longer tail towards the right. So we can go ahead and explain it like that. Okay, that if you are to explain this in terms of skewness, to explain this is now the taxation data set, that's how we would explain it. We'd go ahead and say that the taxation data set has a positive coefficient of skewness, which implies then you start describing. In other words, you start describing the shape of the distribution. What does the positive skewness imply? Okay, because they're telling us to explain the skewness. Okay, this positive 1.788. What does it mean? What does it imply? Of course, you will first state that it has a positive skewness. And what does that imply? It implies that the mean of the data set is greater than the median, and that the data distribution has a longer tail towards the right hand side of the distribution curve. I'm going to write an explanation, but I'm just giving you an audio overview of how to explain it. So that is how you would explain it, explain the positive skewness. So if we come to the finance data here, they're asking us to explain the finance data. Our skewness is a negative value. If it's a negative value, this is what it means according to the diagram we have here. This is what they mean right here. So this diagram, that is what they mean by negative skewness. So what does that imply? Still again, you start describing the features of the graph. That if having a negative skewness, it means that it has a longer tail towards the left hand side of the distribution curve. And so the longer tail towards the distribution curve means that it has data that is pulling the mean towards the left. So I think, let me just write these explanations to bring out the picture, but I think you've understood the overview of how to answer this question. Now here I was just talking about the skewness. You state the skewness, and in explaining the skewness, you're explaining the features of these graphs. I'm going to just make a write-up for you to follow up. Then of course, when it comes to the spread simply means just how spread out the data is. Now normally the spread is better identified, or we are better able to tell how data is spread out, or how scattered is it. Okay, that is what we mean by spread. Like, how scattered is this data? Normally the metrics that are better at telling us the measure of spread are things like standard deviation and variance. But now here they're telling us to comment on the spread, and yet the data that has been given us is just, they're telling us to comment on the performance in terms of skewness and spread. And the performance here they're telling us is Karl Pearson's performance, okay, coefficient. So basing on this, we go by the magnitude, okay? So we shall simply just say that, well, because given the data we have been given, based on this magnitude, the taxation data set, which has an absolute coefficient of skewness here of 1.788, okay, the taxation data set has a lower spread compared to the finance data. So the finance data has a higher spread. Now here we go by the magnitude of the coefficient. Now someone could get confused, that what do you mean? This is 1.788, okay, and this is negative 2.788. But we are saying that as far as spread is concerned, this negative 2.788 shows that this data set for finance data is more spread compared to the taxation data set, which has a lower magnitude. We are now looking at magnitude, not the sign. Ignore the negative. We are looking at the magnitude. The magnitude here, 1.788, has a lower spread compared to 2.788. Because its magnitude is higher, it means it is more spread out. The finance data, which has negative 2.788, has greater spread. Now that greater spread, in other words, the data has been spread out greater than when it comes to taxation, could be as a result of a lot of data points that are very far away from the mean, okay? I mean very far away from the median. You have a lot of data sets that are very far away from the median. They are more spread out to the extreme ends. So because they are more spread out, that's why we are having a bigger coefficient of, skewness for the finance data compared to the taxation data. So to answer Roman 2 very well, let me just do a write-up here, and we call this a video. So again, the question says, comment on the performance in terms of spread and skewness in the above two cases. So let me go ahead and write here. I'm going to comment in terms of spread and in terms of skewness. So in terms of spread,